Okay, so guys, let us start with the next example on mergers and acquisitions. Now we're going to start with question number 10 from the worksheet, from the handout. And the same sum is there in your study material. It is test your knowledge question number 28. Now let us go through the information that is given in the question. And you want to have 5 requirements, right? The 5 questions, the 5 subdivisions. And we shall discuss each subdivision and then take up the solution for that subdivision. Is that fine? So let us go through the data given in the question. Yes, ma'am.
So BA Limited and DA Limited, both the companies operate in the same industry. The financial statement of both the companies for the current financial year are as follows. The balance sheet is given. So current assets for BA 14 lakh, DA 10 lakh. A fixed assets net 10 lakh and 5 lakh. So total 24 lakh and 15 lakh. An equity capital of rupees 10 each, 10 lakh and 8 lakh. Retained earnings 2 lakh and nil. 14% long-term debt 5 lakh and 30,000.
Okay.
Then current liabilities 7 lakh and 4 lakh.
Okay.
So in all 24 lakh and 15 lakh. Then comes income statement. Net sales 34 lakh and 50,000 for BA Limited and 17 lakh for DA Limited. And cost of goods sold 27 lakh 60,000, 13 lakh 60,000. So GP 6 lakh 90, 3 lakh 40. Operating expenses 2 lakh, 1 lakh. Interest 70,000, 42,000. Earnings before taxes 4 lakh 20,000, 1 lakh 98,000. Taxes at 50%, 2 lakh 10,000 and 99,000. Then earnings after tax 2 lakh 10,000 and 99,000. So additional information: number of equity shares 1 lakh 80,000. Dividend payout ratio 40% and 60%. Then market price per share is rupees 40 and rupees 15.
Okay.
Assume that both companies are in the process of negotiating a merger through an exchange of equity shares. You have been asked to assist in establishing equitable exchange terms and are required to: number 1, decompose the share price of both the companies into EPS and PE components, and also segregate their EPS figures into return on equity and book value or intrinsic value per share components.
Okay, now wait. Let me take up each subdivision. So the first requirement you have been asked to decompose. Let me explain that term later. Now you have been asked to decompose the share price into the price earnings multiple, the price earnings ratio, and also what? The earnings per share, right? And also you have been asked to deconstruct, or you have been asked to break the earnings per share into 2 parts. What is that? It is a return on equity, and you have been asked to find something called the book value per share. They shouldn't have used the word or phrase intrinsic value. Intrinsic value has a different meaning altogether. In fact, they are wrong. In fact, they should have said only book value per share. Okay. Now, basically, I've been asked to calculate 4 numbers. Number 1, you have been asked to calculate the earnings per share. And then you have been asked to calculate the price earnings ratio. You have been asked to calculate the return on equity and the book value per share. These are the 4 numbers you're supposed to calculate. You can just you can just ignore these words, decompose. And then what is the next word given? They're given decompose the share price into EPS and price, and segregate. Okay. They use the word segregate the earnings per share into the return on equity and book value per share. Okay. Very, very simple. Now you all know that how to calculate the earnings per share. You must have done your accounting standard 20 in your intermediate. It's nothing but see, I want the earnings or the profit per share. It is a per share earnings. Now over here, tell me, go to the income statement and just tell me what is a PAT or the net income given for company BA. Let's assume that I'm BA Limited and you guys represent the shareholders of DA Limited, right? And you're going to find later BA will acquire DA. So BA will be the acquiring firm and DA will be the target firm. Okay. Now, what is a PAT or is a net income? For my company is given as rupees 2,10,000, right? And that is a net profit available to whom? The holders of equity shares. And tell me how many equity shares are outstanding in my company?
1 lakh.
It's given 1 lakh shares. They haven't given on the balance sheet. Balance sheet, I think they given only the share capital amount as 10 lakh, right, for BA. That means 1 lakh shares of rupees 10 each of face value, 10 lakh.
They're given 10 each.
They're given 10 each,
Yeah.
of rupees 10
Yeah.
each. Okay. So there are 1 lakh shares outstanding in my company. And what is the net profit reported by my company? 2,10,000. Now divide 2,10,000, the earnings, that is a profit after taxation, is a profit available to whom? The holders of equity shares. And one more thing, suppose the company had some preference shares, what? You are supposed to minus the dividends on preference shares. You got to minus that and find the profit available to whom? The equity shareholders. Is that fine?
Yes.
So you take the profit, 2,10,000 and divide that by 1 lakh shares. How much you get?
2.1.
It is rupees 2.1 is a profit or earnings per share. Is rupees 2.1. And we can do the same thing for your company as well. You have to divide rupees 99,000, that is the earnings after taxation available to the equity shareholders. You can divide that by number of equity shares in your company. How many?
80,000.
You guys are holding 80,000 shares in DA. So 99,000 rupees upon 80,000, how much you get?
1.2375.
That is rupees 1.2375. That is the earnings or the profit per share. And then you have been asked to calculate the price earnings ratio. That's very, very simple. You have the formula in the ratio, the name itself. What is that? Price earnings. You can divide the price. You can divide the stock price or the market price per share. For example, for my company, BA Limited, I can take rupees of 40, the market price per share, and divide that by earnings per share, 2.1. So what is 40 by 2.1?
19.05.
It is 19.04 or say 19.05 times. Remember, it's the price earnings multiple. That means a company, your BA company shares are trading at 19.05 times earnings. If you try 19.05 into 2.1, you'll get how much? 40. So it is rupees of 40 divided by earnings per share. Price earnings ratio. Price. Take the share price, the stock price 40, and divide that by earnings. Since numerator is price per share, the denominator should be earnings per share. You can divide 40 by 2.1, you get 19.05 times. And then you have been asked to find two more numbers. What is that? You have been asked to find the return on equity. That's very simple. I want to find the profit available on equity funds employed. Now, when I say equity, it is just not share capital equity, also what reserves and surplus. For example, you take my company, BA Limited. Now, what is the share capital on the balance sheet? It is 10 lakh rupees.
1 lakh shares of 10.
10 lakh rupees. And what is the amount of retained earnings or reserves and surplus? Rupees 2 lakh.
Yeah.
In all, rupees 12 lakh is the total amount of equity funds employed. Rupees 12 lakh is the total amount of equity funds employed. Now you can divide the net profit made by my company, how much? 2 lakh and 10,000 earnings available to equity shareholders. Divide. Take the net income, all right? Divide, so return on equity funds. Yeah. Nothing but 2 lakh and 10,000 is the profit earned by company BA on rupees 12 lakh of equity funds employed. Now what is 2 lakh and 10,000 divided by 12 lakh rupees into 100? And that is your return on equity, 17.5%. That's a return on equity funds. And there is one more question. Also find the book value per share. Also find the book value per share. And the book value per share is nothing but dividing the equity funds on the balance sheet, right? The book value of equity, how much? Which is rupees 12 lakh for my company. And divide that by how many shares? There are 1 lakh shares. So what is the book value per share? You can divide rupees 12 lakh by 1 lakh shares. How much again? Rupees 12. It's called the book equity, or you can say the book value per share. So don't say intrinsic values have different meaning altogether. I'll explain that in a bit. So remember, book value per share is nothing but you can divide the equity funds, the balance sheet equity, that is capital plus reserves, right? By number of equity shares, you get the book value per share is rupees 12. Now, why does it say segregate? You can take a calculator and just check this. So we know that the return on equity is 17.5%, right?
Yes, sir.
Now tell me what is 17.5% on rupees 12? You will get 2.1.
Yes, sir.
17.5% is a return on equity funds. We know that the equity is rupees 12 per share. What is 17.5 by 100 into rupees 12? Will work out to 2 rupees and 10 paise. So the return on equity, if you apply that on the book value per share, what do you get? You will get your earnings per share. Please make a note. It is a return on equity. Okay, that is book value per share multiplied by return on equity. Or I can say return on equity when applied on book value per share, I get earnings per share. Got it? If you apply 17.5% on rupees 12, you will get earnings per share rupees 2.1. Okay, that's not a big deal because I'll tell you why. It's not rocket science, okay? So you know how we got the 17.5%? You divided 2,10,000 rupees profits available to equity shareholders by 12 lakh rupees, right? That is how you got 17.5%. 2,10,000 divided by 12 lakh rupees into 100. That is, we have taken the profits and book value equity in total. What is 2,10,000? Nothing but what? 2 rupees and 10 paise per share. Divide that by, what is the book value per share? 12 rupees. What is 2 rupees and 10 paise divided by 12 rupees into 100? Is 17.5%. Got it?
Yes.
So it is not a surprise when you apply the return on equity on book value per share, you getting EPS. So these are the 4 numbers you have been asked to calculate in the first subdivision. What is that? Calculate the earnings per share. Number 2, price earnings ratio.
Return on
equity and a book value per share. Is that fine?
Yes.
Now what we'll do is, let's see the solution given out there. Then once I discuss the solution for the first subdivision, we can pause the recording, then you can jot down the solution in your notebook. Okay?
Yes.
Yes. Go to the solution.
Market price per share is equal to earnings per share into PE ratio, or PE ratio is equal to market price per share divided by earnings per share.
It's a very popular formula. We know price earnings ratio is equal to market price per share, that's price, divided by earnings per share. Yes, ma'am.
So determination of EPS, PE ratio, return on equity and book value per share of BA Limited and DA Limited. Earnings after tax is given 2,10,000 under BA and 99,000 under DA.
Next.
The number of shares 1,80,000. Their earnings per share is 2.1 and 1.237.
This part is clear. So 2.1 and 1.2375. Next.
Then market price per share given 40 and 15.
40 rupees and 15 rupees, 1.5 given in the question. Next.
Then PE ratio is 19.05 and 12.12.
Yeah, you get 19.04 blah blah rounded to 19.05 times the price earnings multiple. And for the other company, 15 rupees is 1.2375. How many times?
12.1.
Okay, next.
The next is equity funds, 12 lakh and 8 lakh.
Because my share capital 10 lakh and retained earnings rupees 2 lakh, not 12 lakh. For your company rupees 8 lakh in share capital and no retained earnings. So 8 lakh is a book value of equity funds. That's nothing but net worth. Next.
The book value per share is 12 and 10.
Nothing but dividing rupees 12 lakh by 1 lakh shares and dividing 8 lakh by 80,000 shares. You get rupees 12 and rupees 10. Next.
The return on equity is 17.5% for BA and 12.37%.
Okay, have you got the formula out there?
Yeah.
You take the earnings after taxation divided by
equity funds into funds.
That is all. Rupees 2 lakh and 10,000 upon 12 lakh into 100. And 99,000 rupees upon 8 lakh into 100. That's it?
Yes.
So that is the answer to subdivision 1, the 4 numbers calculated. So you can just pause the recording and take down the solution. Okay, so listen here. So the first question answered. Now where you have been asked to calculate the earnings per share, price earnings ratio, the book value per share, and the return on equity. So I just want to add one more point. The price earnings ratio, people say, okay, I'll take the stock price. That is a market price per share. If you take the market price per share, the denominator has to be earnings per share for price earnings ratio. I can also take the market capitalization in the numerator. For example, now tell me, Renuka, what is the market price per share for BA Limited?
40.
It is 40 rupees. And how many shares are outstanding in BA Limited? 1 lakh. So what is 1 lakh shares into 40? I can say 40 lakh rupees is supposed to be the market capitalization, market cap, right?
Yes.
That is a market capitalization, 40 lakh rupees. Then I can divide that by rupees 2 lakh and 10,000 earnings instead of per share. So just do this. What is 40 lakh rupees upon 2 lakh and 10,000 rupees?
19.0.
You get the same number. See, remember one thing for price earnings ratio, in case the numerator is share price. That is, you take the price of 1 share, denominator take the earnings per share. In case the numerator is market cap, you take divided by the total earnings. 2 lakh and 10,000 rupees. Is that fine? It's all the same. So now we shall go ahead and take on the second subdivision. What has been asked for?
Number 2, estimate future earnings per share growth rates for each company.
You have been asked to calculate the growth rate in earnings. You know, when do you actually grow your business? Only when the profits are retained by the company and reinvested. Is that fine?
Yes, sir.
Now tell me, what is a dividend payout ratio given for my company BA Limited?
40%.
It is given that 40% is a dividend payout. That means what? That means 60% of the profits are retained by the company. Now, need not be current year. Maybe it's also going forward, right?
Yes.
So BA company pays 40% of their earnings as dividends. That means the balance 60% is retained by the company. So 1 minus 0.4. 40% is 0.4 in decimal format. So 1 minus 0.4 is 0.6. What is that? That's called the retention ratio, also known as a plowback. That's a very popular phrase in economics. You plow back your funds where the profits are retained and reinvested in the business, right? So 40% payout means 60% is retained by the entity. So 0.6 is a retention ratio. And what is the return earned by the company on equity funds? BA Limited, 17.5%. Remember, we got in the first subdivision. We got 17.5% for BA Limited. So why do you take the 17.5? Because what is retained earnings? It's an equity fund. It is a part of equity which is retained and reinvested in the business. So what do? It is 17.5, that is a percent. Okay, 17.5 will do that into 0.6 retention ratio. How much you get? It is 17.5 into 0.6. That works out to 10.5%. So that is a growth rate in earnings. Remember, your growth rate formula is nothing but your retention ratio into return on equity. We apply the return on equity on 0.6 because the profit retained by the company is nothing but equity funds. It is a part of net worth, equity. So apply the return on equity because that is the return your company is earning on equity funds, 17.5%. So even on that 0.6 profits retained, your company will earn 17.5%. So that is our formula for growth rate. And in fact, this formula, you would have done this in your intermediate also in the new syllabus. Okay. That is Gordon's formula. Okay. So Gordon's formula for growth rate, it is a retention ratio multiplied by return on equity. Is that fine? And I'll give just an example for you to understand. Let us say Renuka earns rupees 10 lakh, okay, from employment. She earns rupees 10 lakh per annum. Now let us say she spends 40%. She spends 40% of her income and retains how much? 60%. That is 10 lakh rupees into 0.6.
6 lakh.
6 lakh is a savings. Let us say she's going to go to the nearby bank and invest that 6 lakh rupees, which is 60% of her income. She's going to invest 6 lakh rupees in a bank. And let us say the bank pays a 10% rate of interest on the deposit. Now, I know it sounds outlandish, okay? And no bank is offering 10% on deposit, but still in our fantasy land, there is a bank out there, okay? And that bank is offering what? 10% interest. And name of the bank is Generous Bank, okay? And they are paying 10% interest on your deposit. Now, next year, she will earn another 10 lakh from what? From her employment, 10 lakh. Anyway, that year, 10 lakh again. Plus, she will also earn 10% on 6 lakh. 60,000 will be income from other sources, interest. In all, how much?
6 lakh.
It is 10 lakh. No, 10 lakh income from employment. Plus another 60,000 rupees income from other sources. In all, 10 lakh, 60,000. Don't bother about the TDS, the taxation. I told you, right? We live in a fantasy land, okay? Now check this. What was her income last year? 10 lakh.
10 lakh.
This year how much?
10 lakh.
10 lakh 60,000. If you see the percentage increase in her income, the gross income is how much? It is 60,000 rupees divided by 10 lakh rupees last year income into 100. How much? 6%. That means her income has grown by 6%. I could have computed 6% another way. Now tell me how much of her profit, income she retained last year? 0.6, 60%, right? 0.6. And what is the return offered by the banker? 10%. What is 10 into 0.6? 6%. That's all. Always remember, in case you want to grow your wealth, you are supposed to retain. So just don't blow all your income, right? You are supposed to retain some portion of your income, save, okay? And then reinvest that money. Invest. It is just not saving money, also you should invest. In case you want to grow your wealth. Fine. In case you want to grow your wealth or grow your income, you are supposed to retain the income and reinvest. Yes. So in this example is 0.6 retention for BA Limited. That into 17.5%. So you get 10.5%. And do the same thing for DA Limited. Let's go through the solution and then you can jot down. Yes.
Yes, sir. So retention ratio is 1 minus dividend payout ratio, which is 0.6 for BA and 0.4 for DA. Then growth rate is computed as return on equity into retention ratio, which works out to 10.5% for BA and 4.95% for DA.
17.5 into 0.6 and
12.37.
That into
0.4.
0.4, right? Yes. And that is your earnings growth. That is the rate at which your earnings will grow. Your company's earnings will grow, right? Yes. And pause the recording. Okay, so you're done with subdivision 2. Now, what I will do is I'll skip subdivision 3. We'll come back to that. Okay. In fact, subdivision 3 only will suggest that BA is going to acquire DA Limited, right? Yes. BA will be the purchasing or the acquiring firm, and DA will be the selling or the target company, right? Mm. Now, I'll skip subdivision 3. I'll come back to that. Let me take up subdivision 4 and 5. Now, let's go through subdivision 4, but do remember, from subdivision 3, we come to know that BA will acquire DA. BA is acquiring firm A for acquiring firm, and firm DA is a target, that is a T for the target firm, the acquiree or the selling company, right? And remember, you guys are, when I say you guys, Renuka, Soumya, Kritika and their friends, they are the shareholders of DA. Got it? Yes. So let's go through this, go through subdivision 4. Yes.
So calculate the post-merger EPS based on an exchange ratio of 0.4:1 being offered by BA Limited, and indicate the immediate EPS accretion or dilution, if any, that will occur for each group of shareholders.
So basically, I've been asked to calculate the post-merger profit or earnings per share, post-acquisition, after I buy your entity. I'm going to offer 0.4 shares in my company for every 1 share you guys are holding in your company. Now tell me currently how many shares you guys are holding, Renuka? Okay. You guys are holding 80,000 shares in DA, right? Yes, sir. Now what is 80,000 shares into 0.4? I'll be offering 32,000 shares in my company to you people. Yes?
Yes.
So that is shares, number of shares offered in my company. Got it?
Yes, sir.
So now we shall go ahead and calculate the post-merger EPS and find any accretion or dilution in earnings per share. Now refer to the solution out there. He would have made a 4-column table.
Yes, sir.
Okay, I will read the numbers in this table, okay? Okay. So the column heads are, they made a 4-column table. Okay, it's a nice way to present your answer. They made a 4-column table. The column heads are particulars. Second column BA, my company, and DA, your company. And last column is combined. That is what? Post acquisition. I'm going to include your company in my company, right? Now just see the first line. Earnings after taxation. My earnings are 2,10,000 and your earnings are 99,000. What will be our earnings? Will be 3 lakh and 9,000. No brainer, right? My earnings plus your earnings is our earnings. 3 lakh and 9,000 rupees. If the same earnings continue, okay, no synergy, then should be 3 lakh and 9,000 will be the earnings of the combined entity after takeover. Now just see the next line. It is a number of shares. That is number of equity shares. How many shares are there in my company? 1 lakh. Now how many shares you guys are holding in your company? 80,000. And in the combined, don't write 1 lakh and 80,000, right?
Yes, sir.
So what happens? My shareholders will be holding 1 lakh still, even after we buy your company. But how many shares are given to you people?
32,000.
Exactly. So 1 lakh and 32,000 shares will be the total number of shares in my company after takeover. After I take over your company, the total number of shares in my company will be 1 lakh shares are still held by my shareholders, no doubt. I'm going to give another 32,000 shares that are issued by me to you people. In all, there will be 1 lakh and 32,000 shares in BA Limited after takeover of DA, right? 1 lakh and 32,000 shares. Then next time finding out the earnings per share. For BA, it is 2.1. We already know from the first subdivision, right? For DA, 1.2375. For the post merger, you should divide a 3 lakh and 9,000 rupees by 1 lakh and 32,000 shares. You get rupees 2.341 is a post acquisition or post merger EPS. Now comes a trick. How to calculate the accretion or the increase or decrease in earnings per share. Now tell me what was my earnings per share pre-merger? It was 2 rupees and it was 2 rupees and 10 paise. Earnings per share, 2.1. Total earnings, 2 lakh, no doubt. So 2.1 per share. And what is a post-merger EPS? 2.341. Yeah. On 1 lakh shares, right? Yes, sir. Totally there are 1 lakh and 32,000 shares. Of that, 1 lakh are still held by my shareholders. And you guys are holding how many shares in my company? 32,000. I gave you guys 32,000 shares, right? Yes. So the post-merger EPS 2.341. Now my EPS pre-merger 2.1, post-merger 2.341. My shareholders will gain 0.241 per share. No doubt at all. Straightforward. But I cannot do the same thing for you guys. I'll tell you why. A person holding 1 share in your company gets only 0.4 share in BA Limited. Yes or no? Yes, sir. So what you should do, you should not compare 1.2375 with the 2.341. That is a wrong comparison. Why? Because a person holding 1 share in DA gets only 0.4 shares in BA Limited. In BA Limited, the purchasing company. What you should do? What is a 2.341 into 0.4? And that number should be compared with 1.2375. 0.93. Because a person holding 1 share gets only 0.4 shares in BA. So what are you going to do? 0.4 into 2.341.
0.936.
Now this should be compared with 1.2375. There is a dilution, decrease in EPS.
0.301.
Exactly. But now there is another way to do this. What are you going to do? Now tell me, Now, how many shares you guys are getting from BA? Only 32,000 shares. Now, what is 2.341 into 32,000?
Sorry?
What is 2.341 into 32,000 shares?
2.341 into 30.
Into 32,000 shares.
74,912.
What is that? Out of 3,09,000 rupees profit, no? Combined.
Yeah.
Earned on 1,32,000 shares. Nothing but 2.341 per share. What is the earnings on the 32,000 shares? Because that is your share of earnings post-merger. Yes or no? You guys are getting only 32,000 shares in my company. So 32,000 shares into 2.341 will give you what? Your post-merger earnings. What you will earn? 70? How much?
74,900.
Exactly. But how much you were earning earlier?
80,000.
You were earning 80,000, right? Now 99,000. I'm sorry, 99,000. You were earning rupees 99,000 earlier, right? EAT. From 99,000, it has come down to 74,000. So what is the difference?
24,088.
This is your fall in earnings. You get it?
Yes.
This is a dilution. I can also find this dilution per share divided by 80,000 shares you guys are holding.
0.30.
Same, we'll get 0.30. That's it. Remember one thing. You just cannot say for my company, not an issue. Why? My shareholders are holding 1 lakh shares before merger. Even after what? 1 lakh. The reason is please refer to the combined column. In the combined column, what is the total number of shares? 1,32,000. Yes or no?
Yes, sir.
That includes what? 1 lakh shares held by my shareholders. And what is 32,000 given to you people? Right? You guys are not getting a 1:1 ratio. You're getting what? You're getting a 0.4:1. Got it?
Yes, sir.
So now these, just see the chart. After EPS, what is the next line? It is accretion or dilution. For my company, straight away you can compare 2.341 and 2.1 and say 0.241 positive. That means accretion, increase. Whereas for you guys, is a dilution. But don't compare the numbers straight away. What you should do? 2.341 the post-merger EPS multiplied by the exchange ratio 0.4. Then compare that with 1.2375. It's gone down by how much? 0.301 in brackets or negative. Okay, now they see, have they given a note below the chart? Below the table, there is a note. I think how they got the 1,32,000 shares. And also there is a note how we got the dilution of 0.301. Read now what is given.
Is this the shares outstanding combined is 1 lakh shares plus 0.4 into 80,000
Exactly. 1 lakh shares. My shareholders will be holding 1 lakh anyway, even after merger. So that plus 0.4 into 80,000. That's the number of shares given to you people, 32,000. In all, 1 lakh? 32,000 shares. Then
EPS claim per as per old share is 2.34 into 0.4. That is 0.936.
That is the EPS claim for, see, a person holding 1 share gets only 0.4 share in BA, right? So 0.4 into 2.341. 0.93.
0.936.
So 1.2375 minus that. Have they done?
Yes, sir.
So that is the
EPS dilution is equal to 1.2375 minus 0.936, which is 0.3015.
Rupee 0.3015 is a dilution per share. Is that fine?
Yes, sir.
And please go ahead. You can pause the recording and plot the solution in your notebook. Okay, so guys, let us start with, let's read subdivision 5, the question. Yes, ma'am.
Yes, sir. So based on an 0.4:1 exchange ratio and assuming that BA Limited, the pre-merger profit earnings ratio will continue after the merger, estimate the post-merger market price. Also show the resulting accretion or dilution in pre-merger market prices.
So the question is based on an exchange ratio 0.4:1, the same exchange ratio. And they say that the price earnings ratio, of a BA Limited, how much you got? I think 19.05 times will be the P multiple even after merger. That means even the combined company is going to have a price earnings ratio of 19.05 times. Is that fine? That's what they meant.
Okay.
Based on that, you have been asked to determine the market price per share of the combined company. Now, you just tell me, what is the earnings per share for the combined entity, Renuka?
It's 2.3.
You got 2.341.
Yeah.
And you also know that earnings per share into price earnings ratio gives you the market price. Yes or no?
Yes.
If you multiply, see, we know that price earnings ratio is equal to what? Market price divided by EPS. Or earnings per share into price earnings ratio will give you what? Market price. Which we discussed even the first subdivision, if you recall.
Yes, sir.
Remember 40 rupees market price of BA by 2.1 EPS of BA give 19.05 times. Or 2.1 into 19.05 will give you what? 40. The same thing can be applied for the combined firm.
Yes, sir.
What is a combined firm's EPS? 2.341.
2.34.
And what is a combined firm's PE ratio? Same 19.05, same as BA.
That's what they want.
That's what is given. The question is given that assuming that the price earnings ratio will be the same. So what is 2.341 and that into 19.05?
44.5.
That is supposed to be the market price. That is supposed to be the market price per share of the combined firm. Fine.
Yes, sir.
And then you have been asked to find any accretion or dilution in market price. So for BA Limited, for my company, very simple. You can make a straight comparison. It was 40 rupees earlier, now 44 point something. So increase in market price, accretion. But for you people, I cannot make a straight comparison, the 15 rupees and 44. The reason is what? A person holding one share gets only 0.4 shares in my company.
Yes.
Got it?
Yes.
So what you should do, 44 point something, whatever you got, the combined, that is market price, a combined
5.9 or 6.
that into 0.4 and then compare that with 15 rupees, right?
Yes, sir.
Now let us go through the solution given out there.
Yes, sir. So earnings per share for BA is 2.1, DA is 1.2375, and combined is 2.341.
This we already know earnings per share. Next
PE
line.
ratio is 19.05, 12.12 and 19.05.
Next line.
The market price per share is 40, 15 and 44.6.
So the 40 and 15, if you want, you can straight away copy from the question. You know how to do 2 rupees and 10 paise into 19.05, right?
Yes, sir.
And for D also you can copy the number 15 rupees as it is. Whereas for the combined firm, you can take 2.341 into 19.05.
Yes.
And that is supposed to be the market price. Next.
Then MPS accretion for BA Limited is 4.6 and for DA Limited it's 2.84.
How they got 2 point something? It is 44.6 into 0.4 exchange ratio and compare that with 15 rupees.
Yes, sir.
So what is
44.6 into 0.4, 17.84.
And whereas it's pre-merger 15. So what is accretion?
2.84.
That's all. That is a accretion. Next line. The accretion is 4 point something.
6 and 2.8.
And 2.8. That's it. Have you got a note for 2.8?
Yeah, that's what I read.
Very good. So please go ahead and jot down the solution in your notebook. Then just pause the recording. Okay, so let us go ahead and take on subdivision 3. That is the last subdivision. Let us take up subdivision 3. Yes.
So based on expected operating synergies, DA Limited estimates that the intrinsic value of DA's equity share would be rupees 20 per share on its acquisition. Now you are required to develop a range of justifiable equity share exchange ratios that can be offered by DA Limited to the shareholders of DA Limited. Now based on your analysis in part 1 and 2, would you expect negotiated terms to be closer to the upper or the lower exchange ratio limits, and why?
See, over here, see the intrinsic value of your company is rupees 20. Yes or no? Which is not same as a book value per share. Refer to answer to subdivision 1. Let me know what is the book value per share you got for your company. You know, you divided rupees 8 lakh by 80,000 shares, you got rupees 10 per share. So that's why I said intrinsic value is not book value. Whenever we say intrinsic value of any asset, whether it's going to be shares in a company or it's going to be some, an aircraft, or let us say a motor car or a building, for any asset, intrinsic value is nothing but the present value of all the future economic benefits. The present value of all the future cash inflows the asset will generate for its holder is supposed to be the intrinsic value of an asset. Is that fine? So now, let's try to understand this. Now tell me, so what is a minimum exchange ratio? Let's find that first. The lower limit. Very simple. Now tell me, your shares are worth how much in the market? Your shares are trading at 15 rupees, right?
Yes.
So if I want to buy your company, I should offer at least how much to you? At least 15 rupees, right? See, I can pay this 15 rupees in cash or in the form of shares. That is secondary. But your shares are worth rupees 15 each, no doubt. Now, how many shares are you guys are holding in your company? Renuka, Soumya, Kritika, and blah, 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 all your friends are holding 80,000 shares. Tell me, what is the worth of your company? Take a calculator, 80,000 shares into 15, how much?
12 lakh.
Exactly. Your company's market value is around 12 lakh rupees, right? I can pay this 12 lakh rupees in cash if I want to. Or I can give shares in my company. And my company shares are worth how much? 40 rupees 40. Every share, right? Now what is rupees 12 lakh by 40? I have to issue 30,000 shares to you people. Logical? Yes. I know that your shares are worth rupees 12 lakh. I can just call you people and give you rupees 12 lakh in in cash, right? That's a liquid. If I have the money, I'll give it to you. Okay, I'll give you rupees 12 lakh cash to you. Or what I can do, I can pay this 12 lakh rupees in the form of shares in my company, and my shares are trading for how much? 40 rupees, right? So how many shares will equal 12 lakh? Divide 12 lakh by 40, 30,000 shares. That means what? Holders of 80,000 shares will get how many shares in my company? 30,000. What is the exchange ratio? Take a calculator. 30,000 shares given to you divided by 80,000 shares. 0.375. That means for every one share, I'll give you 0.375 or say 0.4. That is what was carried forward to the subdivision, 4 and 5 in the question, right? So ratio at least 0.375:1 should be the lower limit. Yes or no? Yes, that is the minimum price I should offer you people. There is another way to get 0.375 directly. Now tell me, my shares are trading for how much? 40. 40. And your shares are trading at? 15. So divide 15 by 40. You'll get 0.375:1 directly. It's all the same. Yes. Now tell me, but what is your company's worth including the synergy? Your company is worth rupees 20 per share. Your shares are trading for 50 in the market.
Yeah.
But your company is actually worth 5 rupees more than that. Why? Because if I want to take over your company, we are in the same industry. I will enjoy some economies of scale. I'll have some savings in operating cost where I can purchase some materials at a discount. You get it?
Yes.
When I start buying some inputs at a discount, what? My profits will increase. I'm going to have some synergy. Therefore, your company is worth something more than 15. That's what is given.
Given 20.
20 rupees intrinsic value. Now tell me, that means your shares are worth how much? What is 80,000 into 20? Your shares are worth 16 lakh rupees here, not just 12 lakh. You know, the 12 lakh and 16 lakh, 4 lakh is nothing but the synergy that I will enjoy if I buy your company. Yes or no? So I shouldn't mind paying for the synergy. Why? So I'm going to enjoy that benefit anyway. So no harm in paying for the benefit. So rupees 16 lakh is the amount I should pay you guys, right?
Yes.
Now tell me, my shares are trading for how much? 40 rupees. Again, I can pay the 16 lakh rupees in cash to you or pay in the form of shares. But here are shares.
Yeah.
So what is 16 lakh by 40 rupees?
40,000 shares.
I got issue 40,000 shares to you maximum.
Yeah.
So now what is the exchange ratio?
0.5.
You can divide 40,000 by 80,000. 0.5 for every one share. Or I can straight away get 0.5. How? Divide
20 by 40.
20 rupees your intrinsic value divided by my share price trading for 40 in the market. 0.5:1 is the upper limit. That means what? I should not issue more than 0.5:1. Lower limit is 0.375:1. In other words, what? I should offer at least 30,000 shares to you, but not more than what? 40,000 shares. Understood?
Yes, sir.
If I go to offer more than 40,000, what happens? I'll be a loser. It becomes something called the winner's curse. That's what they say. I will win by taking over your company. I'll take over your company. Agree. That's a victory for me because I gobbled your company. I ate away your company. But I am at a loss. Why? I'm going to offer something more than your worth. So I should not offer more than 40,000 shares, and also not less than 30,000. Understood?
Yes.
So 30,000 or 0.375:1 is a lower limit. Upper limit 0.5:1. Now what do you think? Okay, what do you think exchange ratio will be? Will it be towards the lower limit? You think I'll offer 30,000 or offer 40,000 to you people?
30.
I will offer only 30,000 because I'll tell you why. Looking at part 1, part 2, answer to subdivision 1 and 2, in fact, your company has what? Lower earnings per share. You have a lower return on equity. You have a lower price earnings multiple, right? Got it?
Yes, sir.
And you also have a lower growth rate. Even the growth rate is for you how much? The answer to subdivision, what is the answer to subdivision 2? What is the growth rate you got?
4.95.
Exactly, which is way below the 10.5% for my company. That means my company is much, much stronger than your company, right? In fact, you should be happy joining my company, not the other way around. In fact, you should be happy joining my company. Therefore, I will offer not more than 30,000 shares. Right? Yes, ma'am. Now read answer to subdivision 3.
Yes, sir. Intrinsic value based is rupees 20 by 40, which is 0.5:1 upper limit. Then market price based, then it is 15 rupees by 40, so 0.375:1 lower limit.
There is a range. Lower limit 0.375:1, upper limit 0.5:1.
Now, since BA Limited has a higher EPS, ROE, P ratio, and even higher EPS growth expectations, the negotiable terms would be expected to be closer to the lower limit based on the existing share price.
I may not offer more than 0.375 or maybe 0.4 max. Okay, it will be closer to the lower limit and not upper limit. And that is all with this example. Please go ahead and jot down the solution to subdivision 3 as well. Okay. And then take at least 5 to 10 minutes to go through the question and the solution. Okay. You can pause the recording. Okay. So guys, you're done with subdivision 3, right?
Yes, sir.
So let's wind up the session. Okay. So we'll meet tomorrow. Bye-bye.